This month, there's been a lot of head-scratching about the Phillips Curve, the economic model that in theory should describe the inverse relationship between inflation and employment. I say should because the concept hasn't been working. Across many developed markets, unemployment levels have been low for some time, but global prices have simply refused to lift. Why is this significant? Well, the Fed and other central banks use the Phillips curve as a core part of their modelling. If the curve is broken, policymakers find it even harder to set their fiscal and monetary plans. So with the US inflation rate continuing to undershoot its target, especially for consumer spending, the Federal Reserve must be considering if a further rate hike this year is a wise move. The consumer space is certainly interesting at the moment. Yes, consumer spending has been sluggish, but consumer confidence has been rising. What's more, it's an area that is undergoing significant secular disruption. As the evolution in retailing from the physical to the online space plays out, we are likely to continue to see some very clear winners and losers in this sector. As ever though, we're interested in identifying the companies that will not only survive, but thrive in this new environment. Those businesses that are able to provide sustainable long-term returns from robust business models. Specifically, we are attracted to travel, leisure and luxury goods. Corporate earnings growth in Europe remains encouraging, with some signs of genuine revenue momentum developing here. Combined with increased confidence in the region's economic outlook and cheap valuations compared with the US market, positive sentiment for European equities is likely to continue. Meanwhile, if the Fed does hold back on the next rate rise, this could edge the already elevated valuations of the US market even higher.